Hey everyone, welcome to today's Explainer. Look, if you've spent even a minute looking into the mechanics of building real wealth, you've definitely bumped into Benjamin Graham's foundational 600-page giant, The Intelligent Investor. Now, let's be honest, it is historically dense and frankly notoriously dry. But don't worry, because today we're doing the heavy lifting for you. We're going to distill that massive textbook into a fast-paced, super accessible breakdown, focusing purely on the absolute essentials you need to know.
And just to underscore why this text is so absolutely vital, let's look at its biggest fan. Warren Buffett literally called this the best book on investing ever written. No big deal, right? He read it when he was just 19 years old, and he credits it with completely changing the trajectory of his life forever. When the absolute most successful investor in modern history gives a book that kind of ringing endorsement, well, we need to pay close attention. Okay, let's dive right into this. So, the core narrative of this explainer really boils down to one single massive question. What does it actually mean to build wealth? Spoiler alert, it is not about gambling, and it's definitely not about just getting lucky. By mastering the 5 golden rules we're about to cover, you're going to save yourself from some incredibly painful financial mistakes, and you'll finally grasp the true long-term mechanics of growing your net worth. Here is our roadmap for today. We'll start by meeting the infamous Mr. Market. Then we'll learn to separate speculating from true investing. After that, we'll build a margin of safety, choose your specific investing path, and finally, we'll talk about mastering your own emotions. Let's get right into it.
Rule number 1, meet moody Mr. Market. Okay, I want you to imagine you own this really successful local coffee shop, and you have a neighbor who visits every single day. We'll call him Mr. Market. Now, this guy is incredibly erotic. On Monday, he rushes in completely euphoric, totally convinced the coffee industry is booming, and he offers you $1 million for your shop. Awesome, right? But then, on Tuesday, he's super depressed, acting like the sky is falling, and he offers you $50,000 for that exact same business. You wouldn't take this guy seriously, would you? You'd probably just laugh and tell him to come back when he's sobered up. Yet, crazily enough, this is exactly how we tend to treat the daily price swings of the stock market. Graham's crucial point here is just so profound. The market is there to serve you, not to instruct you. Think about it. When equities take a dive and the news headlines are just screaming disaster, what do amateur investors do? They panic. They sell everything. They literally let their moody neighbor dictate what their hard-earned assets are worth. But Graham teaches us to do the exact opposite. We've got to use the market's wild volatility and panic to buy cheap, and then use its irrational greed to keep our own portfolios totally safe. Moving right along to rule number 2, stop speculating, start investing. Now, we really need to pivot away from all that external chaos of Mr. Market and focus entirely on our own actions. And we do this by drawing a hard line in the sand between 2 very different behaviors. Real investing, it's calm. It's the long-term ownership of an actual business. It's exactly like buying a house that you plan to raise your family in for decades. Speculating, on the other hand, well, that's like buying that exact same house just because some random stranger on the internet tweeted that the property value is going to the moon next week. It's basically treating the stock market like a giant casino. You see, when you buy a stock, you're not just buying some flashing ticker symbol on a screen. You are acquiring true business ownership. You're buying into real cash flow, physical infrastructure, and true intrinsic value. Honestly, if you wouldn't buy the entire business outright, you really have no business buying even a tiny fraction of it. The hard truth is this: boring builds true wealth. Constant hype, that just builds screenshots of a crashing account. Which brings us perfectly to rule number 3, build a margin of safety. And this brilliantly illustrates the whole core philosophy of defensive wealth building. Just think about how a modern bridge is constructed. If engineers are designing a bridge for trucks that weigh 10,000 pounds, they don't engineer the bridge to hold exactly 10,000 pounds. I mean, that would be completely insane. They build it to hold 30,000 pounds, just in case. They bake in structural defenses, because let's face it, things go wrong. Freak weather happens, massive traffic jams happen. Investing requires that exact same level of mathematical caution. So how do we apply this directly to equities? Well, if your fundamental analysis shows a company's true intrinsic value is $50 a share, you don't actually go out and pay $50. No way. You wait patiently for Mr. Market's wild volatility to drop that price down to $30. That $20 gap, that is your margin of safety. It's basically the structural cushion that protects your hard-earned money if the broader macroeconomic environment suddenly flips upside down, or, if the company's management just makes a really dumb mistake. The lesson here is incredibly simple. Never, ever pay full price.
All right, on to rule number 4. Choose your investing path. Graham makes it crystal clear that there are 2 totally valid ways to approach the market. But, and this is a big but, getting caught indecisively in the middle is exactly how people get absolutely wrecked. Think of it like going to the gym. On one side, you have the defensive investor. This person is like the gym goer who just wants a nice light jog on the treadmill to stay healthy. They want zero drama. They just buy broad index funds, invest the exact same amount every single month, and let the magical math of compounding do all the heavy lifting. Now, on the other side is the enterprising investor. This is your financial bodybuilder. They're reading dense corporate financial statements for fun and aggressively hunting down hidden deals. Both of these paths work beautifully, but you absolutely must commit to one. And finally, we arrive at rule number 5, master your own emotions.
This actually brings us to the single most important realization in this entire explainer. Ultimately, the biggest threat to your wealth, it isn't the Federal Reserve and it isn't inflation, it's you. The defining difference between wildly successful, wealthy investors and broke ones isn't raw IQ at all. It is purely emotional discipline. Full stop. Think about it. When equities drop a mere 5%, a staggering number of people out there act like the world is literally ending. But conversely, when some random dog coin or meme stock spikes, FOMO completely takes over and drives them to gamble their entire life savings. Think of investing like flying a passenger plane through really dark clouds and heavy turbulence. A great pilot doesn't just start screaming and yanking the steering wheel around in a blind panic. They remain perfectly calm, they trust their instruments, and they just fly the plane. You've got to build automated habits, like investing a set amount monthly, and completely, ruthlessly tune out all the external noise. So, bringing it all together, here are your 5 keys to wealth. You need a rock-solid business mindset, treating stocks as real flesh-and-blood companies. You need a margin of safety to act as your cushion. You need unbreakable calmness in the face of Mr. Market's crazy mood swings. You need a super clear strategy, choosing between that defensive or enterprising path. And, of course, you need the ultimate superpower, discipline. Mixing these 5 rules together effectively creates a literal fortress around your portfolio, protecting you from toxic social media hype and, much more importantly, from your own internal panic. So, I want to leave you with a question to really chew on. Look at those 5 rules again. Be totally honest with yourself. Which of these rules do you find the absolute hardest to follow in your own life? Take a quick moment to reflect on that, drop your thoughts down in the comments, and hey, don't forget to join us again for our next wealth building explainer. Stay disciplined out there, everyone.